Hello students, welcome to today's session on types of companies and shares. Okay. So students, there are two parts in this topic. First part, I'll be talking about different types of companies that we have in India, and secondly, the different types of shares which we have. So let's first talk about different types of companies. Okay. In India, we have different types of companies as which can be understood from this chart. Now I'll be explaining these companies one by one. So starting with the first one, that is statutory company. Okay. So statutory companies are basically the companies which are created by special acts passed by state legislature or parliament. For example, we have RBI, we have LIC, right? So these companies are accountable to state legislature or parliament. Then the second type of company we have is the government company. Now, government company, as per section 617 of Companies Act of 1956. See, this provision has been given in the earlier Companies Act also. So as per section 617 of Companies Act of 1956, a government company means any company in which not less than 50% of the paid up capital is held by the central government or by any state government or governments, or partly by central government and partly by one or more state governments, and includes a company which is subsidiary of a government company. Then the third is my foreign company. Foreign company. Now, what's a foreign company? Foreign company is the company which has its incorporation outside India, but it has business operations in India. Then we have holding and subsidiary company. Okay. Holding and subsidiary company, again, according to section 4, subsection 4 of Companies Act of 1956, a company is deemed to be a holding company if the other company is its subsidiary company. A company becomes a subsidiary company when the other company controls 51% or more of its paid up share capital, has the right to appoint directors on its board, or is a subsidiary of another subsidiary company. Then, now we talk about the subsidiary company, okay? Because this heading says holding and subsidiary company. So now holding company we have taken up. Now we talk about the subsidiary company. So according to section 4, subsection 1 of the Companies Act of 1956, a company shall be deemed to be a subsidiary of another company if, but only if, please understand, if, but only if, point number 1, that the other controls the composition of its board of directors. Other means the holding company I'm talking about, right? Controls the composition of its board of directors. Number 2, that the first mentioned company is any other company holds more than half its nominal value of its equity share capital. And the third is, that is, the first mentioned company is a subsidiary of any company, which is that other subsidiary. And the last one is that in case of body corporate, which is incorporated outside India, a subsidiary or holding company of the body corporate under the law of such country shall be deemed to be subsidiary or holding company within the meaning that the purpose of this act, whether the requirements of sections are fulfilled or not. Okay. Now we talk about registered companies. Okay. Now, what are registered companies? So companies which are registered under the Companies Act of 1956, which is the earlier one, or the last one, that is Companies Act of 2013, are called registered companies. Under registered companies, we have two types of companies, limited companies and unlimited companies. Under both these, we have public companies and we have private companies. So now, okay. Then let us also talk about what are public companies. So under Section 3, subsection 1, clause 4 of the Companies Act, public company means a company, number one, which is not a private company. Number two, has uh, uh, mm, uh, have have minimum of 7 members and maximum of infinite members, right? And is a private company which is a subsidiary of a company which is not a private company. So if the company is fulfilling these criteria, then this company would be termed as a public company. Okay. Then the private company. So under section 3, subsection 1, clause 3 of the Companies Act, private company means a company which has a minimum paid up capital of 1 lakh rupees or such higher paid up capital as may be prescribed by its articles. Then it has the restriction of the right to transfer its shares. That is, its shares can be transferred only among its members and not to public. Then limits the number of members to 50. That is, minimum number of members would be 2, maximum would be 50. But this would not include persons who are employees of the company. And yeah, that's it, right? Now, the name of the private company ends with private limited company, right? With the public companies, that the company's name should be ended with only limited company. They are not required to put public as the middle name to their company. Okay. Then uh, um, uh, a broad classification, that is listed or unlisted company. Now, what is a listed company here? A listed company is one such public limited company where the securities or whose securities are listed with any recognized stock exchange for trading purposes. Okay. Yeah. So this is mm, okay. Then another classification, as we can see here, is that is limited or unlimited company. So what's a limited company here? Limited company, in limited companies, the liability of shareholder is limited either by shares or by guarantee. Okay. Among these companies, limited by shares are most popular ones, right? Because here the liability of the member is limited to the amount of shares fully paid up by him. Now, then in companies limited by guarantee, the liability of the member is limited to the amount he guaranteed voluntarily to meet out the deficiency of assets of the company when it is wound up. Unlimited company. In unlimited companies, the liability of shareholder is unlimited. That is, in case of losses, in case of debts, or at the time of winding of the company, whatever are the liabilities of the company will be equally distributed among all the members, irrespective whatever has been their contribution in the form of shares or whatever has been their share holding. Now, so in general and in practice, such companies do not exist at all. Right? Now we talk about the second part, that is types of shares. Different types of shares or classes of shares, as we call them, in which companies' capitals to be divided along with their respective rights and obligations are prescribed by articles of association of the company. So, as per the Companies Act, a company can issue two types of shares, that is, preference shares and equity shares. Equity shares are also known as ordinary shares. Okay. Now let's talk about little about the preference shares. According to Section 43 of the Companies Act of 2013, a preference share is one which fulfills the conditions as follows. Number one, that it carries a preferential right to dividend to be paid either as a fixed amount payable to preference shareholders or an amount calculated by a fixed rate of a nominal value of each share before any dividend is paid to equity shareholders. In short, if I want to say here, this means that the preference shareholders have a preferential rights to be paid the dividends before the equity shareholders are paid. Secondly, that with respect to capital it carries or it will carry on the winding up of the company, the preferential right to the repayment of capital before anything is paid to equity shareholder goes to preferential shareholders. Which means that at the time of winding of the companies, whatever is the amount invested by these preference shareholders will be paid back by the companies before anything is given to equity shareholders. Apart from this, a holder of preference shares has the right to participate fully or to a limited extent in the surpluses of the company as specified in the memorandum or articles of the company. Thus, the preference shares can be participating or non-participating in nature. Similarly, these shares can be cumulative or non-cumulative, at the same time redeemable or not redeemable. Now we talk about the equity shares, right? Now, so according to Section 43 of the Companies Act of 2013, an equity share is a share which is not a preference share. Now that's very simple. So in other words, we can say the shares which do not enjoy any preferential rights in the payment of dividend or repayment of capital are termed as equity or ordinary shares. The equity shareholders are entitled to share the distributable profits of the company after satisfying the dividend rights of preference holders. The dividend on the equity shares is not fixed, unlike the preference shares, and it may vary from year to year depending upon the amount of distributable profit available in the company. Now, these equity share capital can be, or you can say these can come with voting rights or with differential rights as to voting, dividend or otherwise in accordance with such rules and subject to such conditions as may be prescribed in the articles of association of the company. In nutshell, we can say that as far as the rights and duties of the shareholder, equity shareholders are concerned, here the articles of association become supreme. Whatever is mentioned there will be honored. Okay. Right. So that's all for today's session, students. I hope you all understood the topic. Keep practicing. I'll see you the next time. If you have any doubts, please contact through my Urban Pro profile. Thank you.